What just happened today is huge because the Federal Reserve Chairman Jerome Powell, he spoke at a Jackson Hole economic symposium. And what he said was that there are some concerns. We are concerned with interest rates, obviously, but everyone is looking at this. And he said that, yeah, there are, he signals job market and inflation outlook could allow for interest rate cut. And the market just ate it up, loved it. The markets just ran up. That was perfect. But here's the reason why this is such a big deal. Okay? It says Powell's open door to rate cut, citing job market risks. What is the matter with the job market? Why is he saying that there's job market risks? Why should this be something that we are looking at compared to just interest rate cuts? Well, it's actually for multiple reasons. I want to read exactly what he said. Right here, okay, it says the Federal Reserve Chairman said that downside risks to the labor market appear to be rising while economic growth slowed in the first half of the year due to slower consumer spending, and added that tariffs have begun to push consumer prices higher, raising the risk of higher inflation, though longer-term inflation expectations are still well anchored. He says, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand of workers. This unusual situation suggests that downside risks to employment are rising, and if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. Okay. So, here's what he said. Let's break it down and actually put it into real life examples. So yes, we have a very peculiar balance right now. How are we going to fix this? Because right now we have tariffs. Tariffs are going to bring in more revenue, but at the same time, they're going to put additional risk on inflation. Okay. With additional inflation, here's the problem. Then, especially when consumers aren't spending, if we see additional inflation, the concern is that businesses are eventually going to lay people off, okay? And as they lay people off, those people cannot go and spend money on other things, which means additional layoffs and additional layoffs and additional layoffs. So here's why it's such a big deal. Yes, we're going to see unemployment go up. We know this, okay? We've been expecting this for quite some time. But here's where it gets interesting. The Federal Reserve is planning on cutting rates, and not by 200 or 300 basis points. No, they're planning on cutting rates by like 25 to maybe 50 basis points. That's going to be their first cut, likely in September. So that's going to happen, and then we will likely see additional spending. And it's not going to be on things like clothing. Okay? It's probably not going to be on things like furniture. It's going to be on some of the bigger items. These are going to be things like housing, cars, right? Things like that. The reason why, and this is why some financial experts are highly concerned with this move, because what they are saying is that we are going to see people are just going to scrape by, and they're going to see interest rates go from 6.5% down to, let's say, 6%, 5.5%, who knows, right? But as they start coming down, okay, and when I say interest rate, I'm talking about like for a mortgage. But here's the reason why it's a big deal. As rates start coming down, the expectation is, okay, if I just wait an additional 3 months, 6 months, rates are going to come even farther down, then I can finally afford that home. Well, here's the problem. This is why it could cause additional inflation. Is if we see people decide, you know what, I can't wait an additional month. I need to get out of the home I'm in into a new one. I'll just pay a little bit more because I don't want to lose this home. So they overpay for something. That's where we're going to see some additional inflation. But here's the other one. This is why it's actually very important. When the Federal Reserve decides to lower rates, what they're counting on at this point is people are not going to spend money because they know there's another rate cut coming. So they're still going to wait. And so normally when you see interest rates drop, we see additional spending. And so inflation goes up. They're expecting it's not going to happen in this case. But again, We just don't know till we get there. That's the big deal. And with the stock market rallying today, and if we see it go up even higher, and now all these stocks are at all-time highs, the concern there is people could sell their stocks. Okay? Sell some of their portfolio. Take that money and go and buy something. Go buy a car, go and put a down payment on a home, maybe go and update their wardrobe, or renovate their home or something like that. So that's the other concern. But I want to show you this, okay? Because this is actually pretty big as well. Canada drops many of its retaliatory tariffs on the United States. It says right here, Canada announced on Friday, which is today, it was dropping most of its counter tariffs of 25% on U.S. goods. Said the tariffs on U.S. auto, steel, and aluminum will remain in place. Says the move comes as the U.S.-Mexico-Canada agreement is scheduled for a review in the next few months. Canada dropping the retaliatory tariffs, that's big. Okay? Not only for people in Canada and the Canadian citizens, but this is big for us here in the United States as well, because now the additional price increase in Canada isn't there, meaning those people can buy more, which means we can sell more, which means we produce more. That's great. So we'll see what happens there. But I do want to show you this one as well. This puts some additional pressure on tariffs. It says higher tariffs are kicking in. We knew this was coming. We expected this. We know it's just a matter of time before tariffs did go up a little bit, and we start bringing in additional revenue. Again, I said it's just a matter of time, and it is. We're starting to see it, but the expectation is over the next 3 months, we are going to see tariffs in everything. As we do, and as we bring in additional tariff revenue, we can take some of that tariff revenue and pay down our national debt. As we pay down our debt and same time we see interest rates go down, that means we can take more of that money, pay more of our debt, because more of that money is going to the principal and not just the interest. So we'll see what happens, but this is really good news that yes, the Federal Reserve sees that it is time to start lowering interest rates. We've been at this for quite some time. We've been talking about interest rates for several years. They first lowered rates substantially in order to pretty much just get through this and through this tough time. And so yes, that happened. But the big one, we need to get back to normal. We are still not normal. So as we get more information on this and more updates, I promise I'll bring you all the latest news and updates as soon as we get it. But as of today, that is what we know. So again, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.